So in this video, we're starting cost of finance. Remember, we just concluded investment, and we know that one of the key decisions which you always have to make is financing decision, and that was what we started in the previous lecture on different types of financing available. But we need to also learn how to quantify those cost of options of financing, and cost is definitely one of the factors you consider before you choose what type of um, capital you want to use to finance your investment. Most of this part of the syllabus you covered in your finance management paper, but there are more to learn. But I'll just quickly do a refresh. But I'll still advise you to go back to those videos in FM to refresh yourself on how to compute cost of different types of finance. Yeah, remember, cost of finance is what we usually refer to as WACC, weighted average cost of capital. And to calculate weighted average cost of capital, you always need to know the proportion of your capital, take for instance equity, multiplied by the cost of equity, plus proportion of debt, multiplied by cost of debt after tax. Remember, your cost of debt has to be cost of debt after tax. And that is how you've been calculating your work. And I remember I gave you some steps too, which I tried to break down into you. First of all, identify all the types of capital you have in your question. Once you know that, calculate the proportion of each capital that you have. Then you calculate the cost of each capital. Then you multiply the proportion of that capital, multiply by that cost of that capital. If you do that for each of the capital, add everything together, that is your work. Yeah, please go back and refresh yourself on how to compute that work. So which means you need to know cost of equity and cost of debt. So if I do a quick refresh for you on cost of equity, we said there are two ways of calculating cost of equity. The first one is dividend valuation model, which means you are using the dividend projection from the company to determine what the cost of equity will be, because you assume that the dividend you are paying to the shareholders is probably the cost of the company, because that is the return the shareholders are requesting for. And this depends on whether there's a growth in dividend or there's no growth. If there's no growth, we said it's just D naught divided by the price X dividend. And this is with no growth. So dividend is just constant dividend. Yeah. However, there might be growth. And if dividend is growing, it means that you have to use it from different formula that says D naught 1 plus G over price X dividend plus G. Right. So remember that formula and try and practice how to use it. I also taught you how to estimate G. Yeah, and I said there are two methods you can use. You can use average method, or you can use the Gordon growth method. So there's a method that says growth is equal to retention multiplied by return on equity, or you can use the formula that I always like to derive from this future value formula equals to PV 1 plus R raised to power N. So if F is your latest dividend, PV is your old dividend, R is your G, then you can estimate what G is, and which means G will be equals to your recent dividend, let's say D1, divided by the old dividend D0, then square root, nth root of that, yeah, all of that minus 1. That is derived from this formula. Okay, that's how you usually calculate your G, and that is cost of equity using dividend model. But you can also use CAPM. Remember, with CAPM, we said for CAPM, cost of equity will be equals to risk-free rate plus beta into RM minus RF. And we said this is usually the market premium. Yeah, this is called the market premium. And this is the risk-free rate on treasury bonds. Right. Beta measures volatility. So if I quickly touch on beta. Beta is your measure of volatility of share price. Yeah, which we always say for market, it is 1. And you need to remember, it is 1 for market. But companies can have different types of beta. But most important things to know is that when you are looking at the beta of a company, you need to be comparing with the market for you to be able to interpret it. So take for instance, if the beta of a company is plus 2, it means that the company is moving the same direction as market, but twice as volatile as the market. So please remember those interpretations that we learned in FM. The last thing I'm going to talk about in beta is using the appropriate beta. So using the right beta. It's very important, because if you use the wrong beta, your cost of equity will be wrong. And if your cost of equity is wrong, then you know definitely that your WACC will also be wrong. So you must have the right cost of equity to get the right WACC. Now, why is the right WACC important? When you are appraising an investment, if you are appraising a project, the best WACC to use for every project is a project-specific WACC. However, you might not have that information, or you might be able to leverage on the company's WACC if you don't want to go through the stress of computing the project WACC. However, there are conditions that must apply. And I told you in the previous lectures those three conditions. Number one is that the capital structure of that company must be the same as the project. And likewise, the project must be in the same business with the company, which means both the business risk and the finance risk are the same. They are not changing. However, if the project is quite very small, tiny, so insignificant, you can still leverage on the WACC of the company to use. However, if you cannot justify those three criteria, then the company's WACC would not be appropriate. Very important. Take note. And sometimes you might also have calculations asking you to calculate cost of equity, and you need to be able to use the right beta to do that. Okay. Look at this question. That is the Danco. Yeah, Danco. Take 1 or 2 minutes to read Danco, and we'll solve it right away. So you have a Danco that operates 75% across retail and 25% in manufacturing. In manufacturing. So we've been asked to calculate the cost of equity, of Danco using the CAPM model. If you look at this question, you will see that we need to remember the formula that was given by M&M for gearing and degearing. And asset beta can be calculated as volume of equity divided by volume of equity plus volume of debt into 1 minus T, then multiply by equity beta. Remember what asset beta is. Asset beta is the beta without the financing risk. So beta with only business risk. Please remember that. Only business risk. Whereas equity beta is the beta, which means beta that has considered both the business risk inherent in the industry and the finance risk. So which means no debt here, that is no gearing if you are talking about asset beta, but here there is a presence of debt, so which means this company is geared. So beta equity is your geared beta, that's another way to call it, while asset beta is your beta without gearing at all. So very important to take note of this. But let's quickly look at this question to just refresh your memory of how to deal with something like, because you will definitely see a question like this in your AFM. Very important. So if you have a company that wants to go into a new industry, as we can see Danco is trying to do, because if you see Danco has 5% in retail, 25% in manufacturing, trying to derive the cost of equity of that company. However, the company is not listed, so we don't have pricing information of the company. So we have to leverage on companies that exist. And we have information of such companies. Like we have a retail company here that is listed, and we have its beta information, but we have equity beta for this company. We have its financial structure. So we can calculate asset beta for retail. So asset beta for retail before we get back to our own company. So let's get the asset beta for the industry without debt, so which means we need to calculate that asset beta without debt. So that equals to volume of equity, which is 80, divided by 80 plus 20 times 1 minus t. Tax rate is given, let's see, at what rate is tax? Tax on corporate profit is 30%. That is given to us here. So 1 minus t, that's 70%. So let's put 70%. Yeah. See, this is the formula I'm trying to apply. Times beta equity, which we know for retail industry is 1.2. So which means if you put all that together, we have a asset beta that is 1.02. And we need to determine the asset beta for industry, that is manufacturing as well. So let's do for so this is for retail, as you've seen. Now let's do for manufacturing. Same approach I'm going to use. For manufacturing, we have equity beta of 1.45. So we need to calculate asset beta. But this capital structure is 45.55. So 55 equity, by 55 equity plus 45 debt. And 1 minus t is 70%, so that's 0.7. If you put that into calculator, we have asset beta of 0.92. So which means we have asset beta for each industry. So if I put this industry, retail, and manufacturing, we have the asset beta of 1.02 and 0.92. And since the company that we're talking about, Danco, does not exist 100% in each of them, this company exists at, for retail, 75%, as you can see here, and for manufacturing, 25%. So it's 75% here, and it's 25% here. So which means the asset beta for our company will be proportion of that. So which means it's going to be 0.75 times 1.02, and that is 0.765, and 0.25 times 0.92, and that is 0.23. So which means the addition of these two will give us the asset beta of our own company, 0.765. And that gives us 0.995. So that is the asset beta for Danco. Now that we know the asset beta for Danco, we now need to calculate the equity beta so that we can calculate our cost of equity. So the same formula I'm still going to use, which is this formula. But this time around, I'm going to be using it to calculate the equity beta. So, and I'm going to be using the gearing of Danco, which is 50-50, as said by the question here. Because I'm gearing back now that asset beta. So this is what I want to calculate, but I know that the asset beta is 0.995, so 0.995 is equals to debt is 50%, so that's 50 over equity is 50, so 50 plus 50 into 1 minus 30%. And that is multiplied by beta equity, which we are looking for. So if I rearrange the calculation, it's just saying that beta equity is equals to 0.995 multiplied by this, all of this. So, and all of that is 0.7 times 50. 0.7 times is 35 plus another 50, that's 85. So times 85, then all of that divided by 50. And if I do that on the calculator quickly, we have 15. We have beta equity that is equals to 1.69. So now this is the equity beta for Danco. Then we can go into our CAPM to calculate the cost of equity. Now that we know the right beta. So risk-free rate was given to be 3%. Now we know beta as 1.69. And market return, let's say, they give us equity risk premium at 6%, so which is market minus RF already. So times 6%. Once you do that, then we have cost of equity that is 13.1%. So that's a good way and a good refresh for gearing and degearing using the M&M formula. So now that we have that, the next thing I'm going to be moving on is you being able to understand that it's not enough to understand the fact that debt always increase cost of equity. Yeah. Remember, if there's anything that is constant amongst the theory that we have looked at under WACC, whether it's traditional theory or is M&M with tax or without tax, we know that once you are increasing debt, your cost of equity is expected to go up. For all of them, they all agree with that fact. Cost of equity will always go up when you are increasing your gearing level. Yeah, that is given. Yeah, remember, this is what traditional drawing said about WACC will keep coming down until the point where everything starts to go up. Although M&M says it will keep going down forever. Yeah, but that's not what I'm touching on. What I'm touching on is the fact that once debt is increasing, cost of equity is also increasing. But what you want to know is, how do you quantify the impact? You need to be able to calculate the impact. So you want to be able to quantify the impact of debt on cost of equity. Very important. So when I change my capital structure, when I increase my debt or decrease my debt, what will be my new cost of equity? That is the question that you need to be able to answer. And to be able to do that, M&M also gives us a new formula. Yeah. So I'm going to write it again. So we said cost of equity for geared company plus volume of debt divided by volume of equity multiplied by cost of debt into 1 minus T is the same thing as cost of equity now for ungeared company. That's why KEI plus volume of debt like we have on this side divided by volume of equity like we have on this side. But this time around, multiply by cost of equity because it's an ungeared company. Then the volume of debt that we already put that. Yeah. 1 minus T. Still going to put it because of the volume of debt here that we're trying to do here. So you see, the formula on this side is similar as the one on this side. So for me, it's easier for you to memorize like that. But whichever way is easy for you, you can rearrange it as much as you want it. But like I said, remember, the only item you are not familiar with in this formula is KEI, which is just the cost of equity. Cost of equity in an equivalent ungeared company. Very similar to gearing and ungearing that we dealt with just now. Yeah, it's the same approach we're going to be using. And I think the best way to explain is to just try and solve a question. So let me solve a couple of questions. Now let's look at Lavina Co. Look at Lavina Co. Like I always say, pause. Look at the question before you follow the solution. Yeah. It's an equity finance company, yeah. So which means 100% equity finance. There's no debt. So what they have told us invariably is that 9% that you're looking at is your KEI because it's on geared company that has that cost of equity. And they give us the volume of debt and volume of equity, that is 70. The cost of debt is given 4% and tax 30%. And we're asked to calculate the cost of equity. Yeah, if they refinance to 30 to 70. Remember, currently they are on finance with debt, so which means KI is 9%. But if they change it to 30 70, what will be the cost of equity? And that is talking about this part. Okay, So use the same formula that we have. K is what we want to calculate. So K plus volume of debt is 30. And equity is going to be 70. So plus 30 over 70 multiplied by 4%, which is cost of debt, multiplied by 0.7, that's 1 minus T. Yeah, is equals to KEI. We know that to be 9%. That is ungeared cost of equity that has been given. Plus, now we're trying to get back 30 over 70 multiplied by the same ungeared 9%, then multiply by 0.7, 1 minus T. So let's resolve that quickly. So we have 0.7 multiplied by 9% multiplied by 30 divided by 70 equals to 0.027 plus 9%, 0.09. So that is 0.117 here. And on this other side, we have 0.7 times 4% times 30 divided by 70 equals to 0.012. So KE equals to this minus 0.012. And that gives us 10.5%. Yeah. So that is simply what cost of equity will be after the debt of 30% has been introduced. The next question is similar but slightly more difficult. Mundo Co. is already 2080 finance with debt and equity, which means the 12% that we have is not KEI, is KE. So if you are changing the gearing to 25%, then you need to first of all remove the gearing to get the KEI from initial one before we get back at 2575. So which means using that formula, KE of 12% plus debt is 20, so it's 20 over 80, because remember the formula VD over VE. So 20 over 80, that's the current finance structure. The cost of debt was given to be 4%, so multiply by still 4%. Tax 30%, so 1 minus T, 0.7. So that is equals to KEI that we want to calculate plus 20 over 80 multiplied by KEI again that we are looking for, then multiply by 0.7. So we try to simplify this. We should have something like this. So let's say 0.7. Let's do this part first. So 0.7 multiplied by 0.04 multiplied by 20 divided by 80. That gives us 0.007 plus 12%. That's 0.12. And that's 0.127 equals to the other side. It will be 20 divided by 80 multiplied by 0.7. That's 0.175. So KEI plus 0.175 KEI. So if you add this together, that is equals to 1.175 KEI. So which means KEI equals to this 0.127 divided by 1.175. And that should give us what we're looking for. So 0.127 divided by 1.175. And that is equals to 10.8%. So we know KEI is 10.8%. Yeah. So if KEI is 10.8%, now that is the cost of equity for an ungeared company. Now, what we want is cost of equity for a geared company using this debt ratio of 25/75. So which means the KE that we are looking for plus the new debt is now at 25 over 75 multiplied by cost of debt, still 4%, 1 minus T, 0.7. Without no KEI to be 10.8%, then plus the capital structure multiplied by KEI of 10.8% multiplied by 0.7. Yeah. Remember the formula, please. So KE plus, let's do this part first. That's 0.04 times 0.7 times 25 divided by 75. That's 0.009 equals to the other side. Let's do the other side. 0.7 multiplied by 0.108 times 25 divided by 75. Yeah, plus 10.8%, 0.108. That equals to 0.133. So K is equals to that minus 0.009. And that equals to 12.4%. That is cost of equity for the new gearing structure of 2575. And I hope this is quite clear, because it's very important for you to understand how to gear, how to de-gear. And that will be all I'm going to be covering for cost of equity. But one thing I will just mention quickly before I move into cost of debt is a bit of improvement that came after the CAPM model. Yeah, it's good to know that. And that is talking about the arbitrage pricing theory. APT. Yeah, very important. Yeah, though you won't see any calculation on this because most of the parameters that is being used here are difficult to estimate. But the principle behind it, it's quite good. Because what this is talking about is, this is an improvement on CAPM. Remember what CAPM looks at is, CAPM says that investors need to be compensated for the risk that they cannot diversify. And that risk is just the beta that is focused on systematic risk. CAPM believes that an investor should just get the risk-free plus the premium on market. They are using at the beta of the company. Yeah. That is simply what CAPM is saying. However, this arbitrage pricing theory is saying that it goes beyond the beta. It goes beyond the systematic risk. Yeah, that it should be every form of risk that outside the control of the investor. And it can be so many things. So it's saying that apart from the beta on market, we can also be talking about inflation. So, which means when you are writing your formula for arbitrage pricing model, yeah, saying a risk-free rate plus the beta, yeah, RM minus RF, plus you can have another beta, maybe on inflation, then you have RI minus RF again, plus another beta on liquidity risk, on default risk, on all those risks. So that CAPM formula should be much longer and not just simple formula that we have been using, that we just say RF plus beta into RM minus RF. It's saying that this is not complete, like this is not sufficient. That is what the arbitrage pricing theory is talking about. So please, just to quickly mention that in a passing for you. So we'll move next to cost of debt.